I got a phone call 3 days ago that I wasn't expecting from a dealer I've known for years, someone who moves serious volume, not retail, wholesale. The kind of person who supplies smaller dealers, who fulfills large institutional orders, who's plugged into the supply chain at a level most people never see. And the conversation started normal: market conditions, price action, usual shop talk. And then he said something that made me stop. He said, "We can't get 1,000-ounce bars anymore, not at any reasonable premium. And when we do find them, they're gone in hours." And I asked him to clarify. I said, "You mean you can't get them at spot?" And he said, "No. I mean, we can't get them at all unless we're willing to pay $8 to $12 over spot and wait 3 to 6 weeks for delivery. And that's if the supplier even has inventory to commit." Right now, as I'm processing this conversation, comment when you're watching, because this is the kind of information that doesn't show up in official data releases, but it tells you more about the real state of the physical market than any futures chart or EDCF flow report. And if you value insider perspective that reveals what's happening behind the scenes in the wholesale market, subscribe and comment FinTalk OG so the algorithm knows you're here for the intelligence that matters. Now, before I break down what this means, let me give you context on why this dealer's comment is significant. 1,000-ounce silver bars are the backbone of the wholesale market. They're not what retail investors buy. Retail buys coins, rounds, 10-ounce bars, maybe 100-ounce bars. But 1,000-ounce bars are what institutional buyers purchase. They're what dealers use to fulfill large orders. They're what gets moved between refiners, vaults, and major bullion banks. They're the good delivery standard for large transactions. And they're what gets delivered against COMEX futures contracts when someone stands for delivery. So when a wholesale dealer tells me he can't source 1,000-ounce bars without paying a massive premium and waiting weeks, that tells me the wholesale physical market is tight in a way that retail investors don't see, because they're buying smaller products that are still available, just at higher premiums. Here's what I'm going to cover. First, what this dealer told me in detail and why his experience matches reports I'm hearing from other sources in the supply chain. Second, the difference between retail tightness and wholesale tightness and why wholesale is the more important signal. Third, what's causing the shortage of 1,000-ounce bars specifically, from refining bottlenecks to delivery demand to inventory hoarding. And fourth, what this means for silver prices, for premiums, and for anyone trying to buy physical silver in size. Let's get into it. So let me tell you exactly what this dealer said. And I'm not going to name him or his company because this is sensitive information and he shared it with me off the record. But I've verified parts of what he told me with other contacts in the industry, and the pattern is consistent. Here's what he described. His company normally sources 1,000-ounce bars from a network of suppliers, major refineries, larger dealers, bullion banks, and sometimes directly from mining companies or importers. In a normal market, when he needs to buy 100 or 200 or 500 bars to fulfill an order, he makes a few calls, locks in pricing at spot plus a small premium, maybe 50 cents to $1 over spot, and the bars show up within a few days or at most a couple weeks. But over the last several months, that process has broken down. He told me that when he calls his usual suppliers, the response he's getting is one of three things. 1, "We don't have inventory right now. Check back in a few weeks." 2, "We have a small amount, but it's already committed to other customers." Or 3, "We have bars, but the premium is $8 to $12 over spot, and delivery is 3 to 6 weeks out." And when he asks why the premiums are so high and the delivery time so long, the suppliers are telling him that they're having trouble sourcing bars themselves. The refiners are running at capacity, but they can't get enough feedstock. The bars they do produce are being snapped up immediately by larger buyers, and the available inventory in the market has dried up. He also told me something that really stood out. He said that even when he's willing to pay the elevated premium, there's no guarantee the order gets filled. He gave me an example. A few weeks ago, he had a customer who wanted to buy 250 bars. That's 250,000 ounces. A $20 million order at current prices. He contacted multiple suppliers, got quotes in the $10 to $12 premium range, and tried to lock in the order. Two of the suppliers came back a day later and said, "Sorry, the inventory we thought we had just got claimed by another buyer. We can't fulfill your order." So he had to go back to the customer and either delay the order or source smaller bars at even higher per ounce costs. Now here's why this matters. This dealer moves millions of dollars worth of metal every month. He's not some small time coin shop. He's a serious player. And if he's struggling to source 1,000-ounce bars, that tells me that the institutional and wholesale market is experiencing a level of tightness that's not visible to retail investors who are still able to walk into a coin shop or order online and get silver eagles or rounds, even if they're paying elevated premiums. The retail market can be somewhat insulated from wholesale tightness because retail products, coins, small bars come from a different part of the supply chain. They're minted from smaller feedstock, they're produced in higher volumes, and they have different distribution channels. But 1,000-ounce bars are the wholesale product, and when that market tightens, it's a signal that the underlying physical supply is under stress. Now let's talk about the difference between retail tightness and wholesale tightness. Retail tightness is what most people see and experience. It shows up as high premiums on silver eagles, long wait times from online dealers, sold-out signs at coin shops, and back orders on popular products. And we've seen that periodically over the last few years. During the 2021 Reddit squeeze attempt, retail premiums spiked to $12, $15, even $18 over spot for silver eagles. During the run-up in late 2025 and early 2026, premiums hit similar levels. So, retail tightness happens. But retail tightness can be temporary, and it doesn't always reflect deeper issues in the supply chain. Sometimes it's just a surge in retail demand overwhelming the mint's production capacity. The mints catch up, premiums compress, and the market normalizes. Wholesale tightness is different. Wholesale tightness means that the large bars that institutions, dealers, and refiners trade are becoming scarce. It means that the inventory buffers in the system are being drawn down. It means that refiners can't produce bars fast enough to meet demand from large buyers. And it means that the people who supply the retail market are themselves struggling to source metal. Wholesale tightness is a deeper, more structural signal, and it tends to persist because it's driven by fundamentals, supply constraints, refining bottlenecks, delivery demand from futures markets, central bank or sovereign buying, not just by temporary retail enthusiasm. When you see both retail and wholesale tightness at the same time, that's when you know the physical market is genuinely tight. And based on what this dealer told me, and based on other reports I'm hearing, we're there. Retail premiums are still elevated. They haven't compressed the way they normally would months after a price spike. And now, wholesale is tight too. That's a combination that historically precedes either a sustained move higher in price or a breakdown in the paper to physical pricing mechanism where physical starts trading at a persistent premium to paper. Now let's talk about what's causing the shortage of 1,000-ounce bars. There are multiple factors, and they're all converging. Factor 1. Refining bottlenecks. I've covered this in previous videos, but it's worth repeating. The global silver refining industry is concentrated. A huge percentage of refining capacity is in China, Switzerland, and the U.S. And all three of those regions are facing constraints. China has restricted exports of refined silver as part of their broader commodity strategy. Switzerland is running at capacity and can't expand quickly. And the U.S. has limited refining capacity to begin with, and what capacity exists is fully utilized. Refiners turn raw silver, door, scrap, or concentrates into refined bars. That process takes time. It requires feedstock. It requires energy, labor, and chemicals. And if the feedstock isn't available, or if one step in the process is bottlenecked, the whole system slows down. Right now, refiners are struggling to get enough feedstock. Why? Because Mexican silver exports are constrained. Because Chinese domestic production is being retained domestically. Because scrap flows have declined as silver prices rose, people aren't selling old jewelry or industrial scrap when they expect prices to go higher. So refiners have metal they want to process, but they can't source enough raw material. And that means production of 1,000-ounce bars is lower than demand. Factor 2. COMEX delivery demand. When someone takes delivery against a COMEX silver futures contract, the metal delivered is typically in the form of 1,000-ounce bars. Those bars come out of COMEX registered inventory, or they're sourced from the market and warranted into registered. As I've covered before, COMEX delivery demand has been elevated. March delivery notices were higher than normal, and every bar that gets delivered against the contract is a bar that's no longer available in the wholesale market unless the buyer turns around and sells it back. If delivery demand remains elevated, and if the people taking delivery are holding the metal rather than flipping it, that removes supply from the market. Factor 3. Institutional and sovereign accumulation. Large buyers, institutions, family offices, sovereign wealth funds, and possibly central banks are accumulating physical silver. And when they buy 1,000-ounce bars. They're not buying silver eagles. They're buying the wholesale product. And they're taking delivery and moving it into allocated storage or into vaults where it sits. That metal doesn't come back to market. It's sticky. It's held for years or decades. Every time a large buyer pulls 500 or 1,000 or 5,000 bars out of the market, that's inventory that dealers like my contact can no longer access. Factor 4. Dealer inventory hoarding. When dealers start to see tightness in supply, they get defensive. They start holding on to inventory rather than selling it immediately. Why? Because they know that if they sell their inventory today, they might not be able to replace it tomorrow at a reasonable price. So they sit on bars even if they have customers willing to buy, because they'd rather have the inventory than the cash. That behavior amplifies the tightness. If every dealer in the chain is hoarding, then the available supply that's actively being offered for sale shrinks even more. Factor 5. Backwardation signals. Backwardation is when the spot price or the near-term futures price is higher than the forward price. It's a signal of immediate physical demand exceeding forward supply expectations. When backwardation appears in silver, it attracts attention from traders and institutions who know it's an arbitrage opportunity. They buy physical now and sell futures forward. But to do that arbitrage, they need to source physical metal. And if lots of arbitrageurs are trying to do that trade at the same time, they're all competing for the same 1,000-ounce bars. That drives up demand and premiums in the wholesale market. When you combine all 5 of these factors, refining bottlenecks, COMEX delivery demand, institutional accumulation, dealer hoarding, and backwardation arbitrage, you get exactly the situation my dealer friend described. Bars are scarce, premiums are elevated, delivery times are stretched, and the wholesale market is tight. Now let's talk about what this means for silver prices and for the broader market. First, wholesale tightness is a leading indicator. Retail investors don't see it because they're buying coins in small bars. The futures market doesn't fully reflect it because futures are paper and can be settled in cash. But wholesale tightness tells you that the physical metal that underpins the entire market is getting scarce. And when the physical market tightens, it eventually shows up in price. Maybe not immediately, maybe not in a straight line, but over time, scarcity drives price higher. Second, the premium structure is inverting. Normally, larger bars have lower premiums per ounce than smaller products because they're cheaper to produce and handle. A 1,000-ounce bar might trade at 50 cents over spot, while a Silver Eagle trades at $4 or $5 over spot. That makes sense. The Eagle has minting costs, government mint premiums, distribution markups. But now, my dealer is telling me he's paying $8 to $12 over spot for 1,000-ounce bars. That's not far below retail premiums for coins. And in some cases, it's higher than premiums for 100-ounce bars. That inversion tells you that the wholesale market is tighter than retail. And that's unusual. It's a sign of deep stress in the supply chain. Third, delivery delays are getting longer. 3 to 6 weeks for delivery of 1,000-ounce bars used to be considered slow. Normal was a few days to 2 weeks. But now, 3 to 6 weeks is the new normal. And my dealer told me he's heard of cases where delivery times have stretched to 8 or even 10 weeks. When delivery times extend like that, it creates uncertainty. Buyers lock in a price today but don't get the metal for 2 months. In a volatile market, that's a huge risk. And it also means that inventory that's in transit or promised for future delivery can't be used to meet current demand. That exacerbates the tightness. Fourth, this sets up a potential squeeze dynamic. If wholesale bars are already scarce and if demand continues or increases, you could reach a point where even large buyers can't source metal at any price in reasonable time frames. That's when you get a true physical squeeze, not a squeeze driven by speculative futures buying. A squeeze driven by actual delivery demand overwhelming available supply. In that scenario, premiums don't just tick higher, they explode. You could see 1,000-ounce bars trading at $20, $30, $40 over spot. And spot itself would likely surge higher as the paper market reprices to reflect the physical scarcity. Fifth, this validates the physical over paper thesis. If you own physical silver, whether it's 1,000-ounce bars, 100-ounce bars, or coins, you own an asset that's becoming harder to source. The premium you paid months or years ago is looking smarter. If you own paper silver, SLV, futures contracts, unallocated accounts, you own a financial claim that may or may not be backed by physical metal. And if the physical market continues to tighten, the spread between physical and paper could widen. Physical could trade at a persistent premium over paper. And in that scenario, owning paper doesn't give you the same exposure as owning physical. Now let's talk about what you should do with this information. If you're a retail investor holding physical silver, do nothing. This news is confirmation of your thesis. Physical is becoming scarce. The wholesale market is tight. Your metal is valuable. Don't panic sell because spot price is volatile or because you're not seeing immediate price appreciation. The tightness is building in the background, and it will eventually reflect in price. If you're thinking about buying physical silver, understand that sourcing large quantities is getting harder and more expensive. If you're trying to buy an institutional size, hundreds of thousands or millions of dollars worth, you need to be prepared for elevated premiums and extended delivery times. And you need to work with dealers who have relationships with suppliers and who can actually source the metal. Don't assume that just because you have the cash, you can get the metal delivered quickly. If you're buying retail amounts, coins and small bars, availability is better, but premiums are still elevated. Expect to pay $8 to $15 over spot depending on the product. And if you find product available at a reasonable premium, buy it. Don't wait for premiums to compress to 2019 levels. They might not. If you're a dealer or wholesaler, this is both a challenge and an opportunity. The challenge is sourcing inventory. You need to diversify your supplier relationships. You need to be willing to pay up for metal when it's available. And you need to manage customer expectations around delivery times. The opportunity is that premiums are high and likely to stay elevated. If you can source metal and deliver it, you can charge a premium and make margin. But don't overpromise. If you can't source the metal, don't take orders you can't fill. If you're an institutional buyer, you need to secure supply now. If you're planning to accumulate silver over the next year, don't wait. Start buying now and lock in what you can. Work directly with refiners if possible. Establish long-term supply agreements. And be prepared to pay premiums. Waiting for better prices or tighter premiums might mean you can't get metal at all. If you're trading paper silver, understand that the physical market dynamics I'm describing may not immediately show up in futures prices or ETF prices. Paper markets can stay disconnected from physical for extended periods. But over time, physical tightness does affect paper pricing, and if a true squeeze develops, paper markets will reprice violently. So if you're short paper silver or betting against it, you're playing with fire. The physical backstop is real. And if physical dries up, paper shorts get crushed. Now let me address the skeptics. Some people will say this is just one dealer's anecdote. It doesn't mean the whole market is tight. Fair point. But it's not just one dealer. I've heard similar reports from other sources. I've seen import data that shows reduced flows of large bars into the U.S. and Europe. I've read dealer commentary on industry forums discussing sourcing challenges, and I've watched physical premiums stay elevated for months, even after the price spike earlier in the year. When multiple independent sources are all describing the same phenomenon, it's not anecdote, it's pattern. And patterns are data. Others will say, if bars are really that scarce, why hasn't spot price exploded higher? Because spot price is set in the futures market, not the physical market. Spot reflects paper trading, leverage, positioning, and macro factors like the dollar and real rates. Physical tightness takes time to feed into spot because most trading is paper. But eventually, if physical stays tight and delivery demand stays strong, spot has to adjust. Because at some point, the arbitrage between cheap paper and expensive physical becomes too wide and someone steps in to close it. That's when spot reprices higher. And some will say this is just temporary, supply will loosen, premiums will compress, it's happened before. Maybe. But the structural factors I described, refining bottlenecks, China export restrictions, Mexico supply issues, institutional accumulation, those aren't temporary. Those are multi-year dynamics. So even if supply loosens in the short term because demand pauses or because some dealer inventory comes back to market, the underlying tightness is still there, and it's getting tighter over time, not looser. Here's my final take. The phone call I got from that dealer is one of the most significant pieces of market intelligence I've received in months. It confirms what the data has been suggesting. The wholesale physical silver market is tight. 1,000-ounce bars, the backbone of the institutional market, are scarce and expensive. Delivery times are stretching. And the people who supply the market are themselves struggling to source metal. This is not the kind of tightness that resolves quickly. This is structural. And it's building. Retail investors don't see it because they're buying coins and small bars that are still available. Futures traders don't see it because they're trading paper. But the people in the supply chain, the dealers, the refiners, the large buyers, they see it and they're acting on it. They're hoarding inventory. They're locking in supply. They're paying up. If you own physical silver, this is validation. If you're thinking about buying, understand that sourcing is getting harder. And if you're ignoring the physical market and only watching spot price, you're missing the most important part of the story. Tell me in the comments, have you experienced difficulty sourcing physical silver recently? Whether it's from dealers, from online retailers, or from other sources. And if you're a dealer or wholesaler watching this, drop a comment and let me know if what I'm describing matches your experience. Because the more data points we have, the clearer the picture becomes. If this breakdown gave you insider perspective on what's really happening in the wholesale silver market, subscribe and comment FinTalk OG and share this with someone who's trying to understand why physical premiums stay high even when spot price consolidates. One last thing. This is analysis based on industry contacts and market observation. It's not financial advice. I'm sharing what I'm hearing and seeing in the market. You have to make your own decisions, do your own research, and if you're buying physical, verify your dealer's ability to source and deliver before you commit large capital. All right, watch the wholesale market, track the signals, and I'll see you in the next one.